G'day, I'm Nick Erner. I'm the Managing Director and CEO of Alkane Resources, ASX and TSX listed under the ticker ALK. We've just completed our merger with Mandalay Resources. Now we have 3 mines producing over 160,000 equivalent ounces a year, generating pretty serious cash.
That you are. Congratulations. I think the merger's now been approved. It's a very different company now. So tell us a little bit more about the kind of process to kind of get there. It seemed to happen quite quickly.
Yeah, Matt, thanks. I mean, relatively quickly. And the last time we spoke was when you, Fraser, and I were together in London whilst we were sort of roadshowing the deal initially. So basically, we've just completed the transaction. As I said in my little intro, we're now ASX and TSX listed, actually OTC QX listed as well. And so what happened was the legal methodology was Alkane did a takeover of Mandalay on the TSX by Alkane listing on the TSX, then taking over Mandalay. And each Mandalay shareholder got just under 8 shares to 1. For every Mandalay share, they got just under 8 Alkane shares. And so, yeah, we've basically, it was a 45% Alkane, 55% Mandalay in terms of total share ownership at the end. But what that means is the 2 Mandalay assets, Costerfield, a gold and antimony mine in Victoria in Australia, and Björkdal, a gold mine in northern Sweden, has now joined the Alkane Tomingley asset, a gold mine in the central west of New South Wales, about 4.5k from Sydney. So now we have 3 assets. If we look back as if the last 12 months we'd been merged the whole time, then we would have done a bit over 160,000 ounces and generated close to $100 million worth of cash into the bank balance. So post-growth, post-tax, post-everything. So you're in really, really solid shape.
So, I mean, obviously, look, you've kind of done the hard bit, and as I jokingly say, now you've got to do the hard bit, which is obviously integrate not just people, but the operations, but I think more importantly, the decision-making and the management of all of the above. How do you go about doing it? How have you divided up the board, and, have you had to change processes as a result?
Well, that sort of stuff. Yeah, that's a good point. So first thing, really similar cultural fit between the 2 companies, which is part of what made the transaction so simple relatively. So each company treated their operations as mostly independent with very few corporate office functions. So that worked well. We haven't had to shift and move much in the corporate office. The second thing is that the boards merged together. So we have 3 people from Mandalay, including their previous chair, Brad Mills, including the previous CEO, Fraser Boucher, who we spoke with, plus also Dom Duffy, another Australian-based director. And on the Alkane side, we had Ian Gandel, our original Alkane chairman, plus myself, plus a new chairman, Andy Quinn, ex-Barrick, moving off the LBMA, heavy hitter with CIBC over the years in London. So, we have a newly formed board and a pretty clear vision. Like, we've come together to grow the business, not just to stabilise in this 160 to 200,000 ounce range, but to grow again on the next leg. So, the nitty gritty, of course, is Mandalay's COO Ryan and Head of Exploration Chris have both come and joined my management team. And so obviously there's a lot of familiarisation in terms of how we allocate capital, but pretty much it's business as usual across both sides, because Alkane was already on its growth and stabilisation path, Mandalay equally so, particularly on drilling out in and around the deposits. So all of that's continuing. But yeah, there is a lot of the, emails, team meetings, meeting schedules, financial reporting, currency handling, all that sort of stuff. But it's largely at the sort of the corporate office level.
Right. And so how do you? Because obviously you talk about growth, was a great word to kind of use and talk about. You got to kind of make it happen, and then you got to kind of help the market, help you realise that growth. You know what I mean, in terms of getting that anticipated valuation re-rate. So in terms of the kind of 3 top strategic imperatives for you, and what do you see those as, and what are you challenging the board with?
There's nothing I would say that's particularly remarkable, right, first step. So first one is maximise the value of our existing assets. And in particular, that's to finish the highway move and bring the open cut online at Tomingley. That's to, at Costerfield in Victoria, it's to demonstrate much further the potential of that. So we already have close to 4 years in reserve and beyond that in resources, but it's to demonstrate, show that pass-through value for that resource to reserve conversion, and then also the new extensions that we're expecting at True Blue close to it, and then committing to that capital program. So that people can say, oh, there's definitely 7 years there, probably at higher production. And then at Björkdal, very efficient mine, is to show, okay, well, how do we increase the grade and the volume mined using building on what we have, not trying to change what we have, building what we have. That's absolute core business, right? And generate cash as we do that. Part two of the business is to say, well, what sort of asset might we be chasing? So we have very broad board alignment on Australia, New Zealand, through Scandinavia, North America as obvious target places. Of course, we'll look at other things should they come up, but in general, we're not looking in Africa, Middle East, the stands, or South America broadly. Some places in South America we might. And so if you look at just the realities of being a company, our valuations maybe, already moved past 1.1 billion. We expect it to go further. We'll come to part three of the leg. So we say, well, what might we do? Well, clearly we're not the kind of people that are going to go and get a $3 billion asset, are we? Right? That's pretty logical. So the next leg is probably something in the 80 to 120,000 ounce per year range with reasonable life, reasonable growth, where maybe it needs to be developed, but it's probably already permitted. We want to see these things being able to come into production in 2027, not too far away. So there's a lot of permitting that needs to already be underway, or a merger with another company that's a single asset. So to put another leg of growth into there for that purpose. But of course, that's been generating free cash because all of our assets are. And then the third leg is what we alluded to with re-rating. So if you look at us versus our peers, and a lot of people can go and look at the comps, you're doing over 160,000 ounces in Australia, a good look ahead of that, putting cash in the bank on a regular basis in the quantums that I've talked about. Well, not many of those people are less than 1.5 billion Australian in market cap. So I'd like to think that we can create that recognition, and certainly achieving a position on the index and other stuff should assist in that. So they're the three immediate things that are, we should see on the front.
If you do those things in terms of this kind of re-rating in the market or recognition in the market, things like the GDXJ, obviously ASX 300, and any other kind of continued liquidity that you may be able to drive. Those things are they sort of in your, how do you feel about them? Are they in your control, out of your control?
Those things are both out of our control, and yet the inputs to making that happen are within our control. So absolutely stable production, cash flow generation, clearly articulated strategies. The board develops that across the next 6 months, obviously putting more details around the high level that I described. All of those things help us maximise value. But meeting your guidance, delivering on your guidance is very, very important. If we look at Alkane as a company, we first poured our first gold in FY14. This is July to June financial years. And we've met our production guidance every single year except one, and that one we were under the bottom end of our guidance by 3,000 ounces. Similarly, Mandalay, last couple of years, they have bang on delivered on guidance and exceeded in cash generation. So, we have a culture within the group of making sure we deliver on guidance. I think that's step one, right? People want to know that you can do the things that you want to do. And then the second thing is showing people that can be continued, the things I talked about with mine life.
Okay, again, I was always intrigued by the kind of integration component here, especially in the early days, kind of got to set the tone right? So merger, fantastic, but within that will be, I guess, some inefficiencies that you'll be looking at. You took a good story about the growth component, but there are other kind of components or assets or activities that you will rationalize And have you identified them, or what is the process to do
Yes
that?
and no, not remarkably, because Mandalay ran a very, very small corporate office. So not a lot there. However, if you look particularly within Australia, there are some procurement efficiencies, not a lot, a couple of $1 million that might be able to be released. There's certainly capital allocation efficiencies. There are some tax things that naturally flow out of the merger and the way that occurs. So we should be some millions of dollars per year better off on each of those. But that's not the main game of what we're looking to achieve, because both were efficient small companies. It's creating the scale and the capacity to do growth at value that comes from that scale. That is particularly what we're seeking to create.
Okay, interesting. In terms of operationally, you sort of outlined some of the goals and some of the targets. I mean, Björkdal, specifically, you talk about moving the highway, etc. Have you got everything in place? Is it just a kind of efficient operational challenge rather than, again, permitting, licensing, and any other kind of regulatory barriers that may be there?
Certainly, if we work through the assets one by one, let's run with
that'd be great.
If the answer to that question is yes, at Tomingley. Let's move to Costerfield in Victoria. New tailings dam just built, 7 years, capacity within it. True Blue, something that we see as a potential future, certainly, so amazing hits, ounces per tonne across multiple hits there. So, mined diluted grade in excess of a half ounce per tonne, right, over 1.8 metre mining width. So the development to that does need us to, we can most likely get an exploration drive there approved quite readily, but converting that to a mining lease, remembering it'll be underground, so not particularly intrusive at all on the surface or interfering with the landscape, that will require permitting. But that is typically just a couple of year process, particularly in Victoria, where the government has been very proactive of recent times to allow permitting to occur. So so we'll call that the later years potential of the life, out +5, looking at it. So certainly that fits in the timeframe. At Björkdal, where we're chasing higher grades to feed to the mill or new mining areas, there are some opportunities both within the ML, underneath other deposits that are a few hundred metres from the existing mining areas, and there's also some just a couple of kilometres away, potential open cut. So we need to run those to ground, but certainly we're both in the short to medium term, what I call short within this financial year, and medium within a 3 to 4 year period, very well set.
Good.
Very well set. But what we want to do is make sure that we've laid the building blocks for the medium to long term, where I'm talking the 4 to 7 year time frame. Because in mining, that's what you need to be doing. And that's one of the advantages of coming together, is we reduce the sense of urgency as a group, because we have more time to strategically allocate and pick and move our resources that do that type of work, which is just a couple of people around different operations. So that's our intention.
And so when it comes to things like, I'm just trying to, again, kind of the drivers for the market in terms of, we talked about some of the ETFs out there and some of the indexes, etc. They look for certain criteria for you to qualify and to stay there. So allocation of capital to near mine exploration versus regional exploration. How do you think about that differently now as a result, having reached this kind of scale?
A little. However, we largely moved there as both companies. So we'll spend around the Headframe and within the MLs, and a little bit off it, so readily accessible. We'll spend the better part of 40 million Australian dollars in this coming financial year. Like, substantial swing at it. Whereas regionally, which is outside there, less than 5.
Okay.
So we are really looking to maximise the value of the assets that we have.
So are we saying right now, because obviously gold price being where it is today, cash in the bank is being valued more than the showing scale over and above where you're at What are people valuing, do you think? What are institutions valuing?
Obviously, different investors value different things. All right. So your passive fund, your passive ECF, doesn't value anything except your market cap, and then what are the indexes and how does it enter and all that sort of stuff. There are liquidity criteria and other things to enter in, but that's largely following money. Your fundamental funds, they want to see historical stable production, growth potential, and margin, retaining your margins, right? So they absolutely want to see that. Retail shareholders vary between all different camps, but broad thematics are that people want to see cash flow and people want exposure to gold. And so we do have less than 20% of our production will be hedged going forward, but people want to see that reduce with time. And then people want to see clearly articulated growth strategies. They don't want maybe growth strategies. They don't want capital moved around. And then if there isn't a growth strategy, people want to see dividends or share buybacks. At the moment, as we firm that up, we'll be looking to articulate a growth strategy first before we start to review, returns of capital in that over the next 12 months. But they're the things that people are looking for.
Okay, which makes a lot of sense. Obviously, cash and bullion at the moment is you're doing just fine. And so, some of the things that we like to look at is obviously you mentioned there margin and improving margin. You get that two ways by obviously making sure your costs are low, and then the other one out of control is what the gold price decides to do at the moment. So at Tomingley, for instance, I mean, what have we got coming up in terms of driving that margin?
Yeah, so
how are you going to do it?
As we've discussed, before, and other producers will have discussed with you, on your podcast, is as price rises, depending on the type of ore body, and Tomingley and Björkdal fit into this, but Costerfield doesn't really. There is the potential to mine very profitable material, but that you otherwise wouldn't have mined. So, you can imagine that there are sections of the ore body that at $5,000 Australian per ounce, you would mine that you wouldn't at $3,500, because obviously if it costs you $3,500 to get it, you're not going to mine it at $3,500, but you're making $1,500 or a margin of damn near 50% if you mine it. Now, what that does do is reduce your cut-off grades, and it also reduces, if you've got fixed infrastructure, as we do at Tomingley, Costerfield, and Björkdal's a different case, you will reduce your ounces per year, but you'll significantly extend the mine life. Right, so that's tension one. But we try and always look at how do we reduce our dollars per tonne, so we separate the two different problems. What's the economic impact of each tonne, and then how can we get that tonne cheaply? Because that allows, the more reliably your cost base is of achieving a tonne, the more reliably you can do the cost basis. So at Tomingley we have things like automation on each level that allows the remote bogging and transport. We have a ore pass. We have things that reduce the cost per tonne, and things that improve the recovery within the plant. Similarly, so at each operation. The reason why I said Costerfield is different is with the vein type structures there, the tightness of the mining and the turnover of very narrow vein mining is what drives that. So it's historically been about 50,000 equivalent ounces, 140,000 tonnes per year is what's done there. So at Tomingley we're doing 1.2 million tonnes per year, roughly. Costerfield we're doing 140,000 tonnes a year. Björkdal we're doing 1.4 million tonnes per year. So the grades are different in each one. Björkdal, very, very efficient, very low cost power. That is all about mining areas and the mine plan and how to maximise the ore grade from each section of the ore body whilst maintaining the sequencing and not sterilising the ore body. So each has its own unique problem. There's nothing I've described that to a mining company is in any way unusual, but certainly input costs have in general stabilised at inflationary rates, which is 3 to 5% depending on what your particular inputs you have are.
So do you find yourself looking at the return on invested capital differently now when you've kind of got cash in the bank versus when you're sitting on a big pile of debt? I'm talking about, I know you've got debt, but a big pile of debt, because there's a kind of different risk tension there, and it gets slightly more out of control with debt in a way. If things don't quite go according to plan, it's always nice to have some debt, but it's fine to have some debt. How do you view all of this across all the different projects now? And can you take a little bit more risk, because it's kind of effectively, so making the language quite simple here, it's your own money, as it were.
Yeah. So it is the company's money, but then of course the company's owned by all of us individually shareholders, each with a different drive. But the overwhelming drive is company profitability. It's certainly true that the true cost of capital is a concept not understood by that many. To expand on it a little, if you're going to do something, there's the opportunity cost of what you could have invested in, there's the return that you're after, there's the return of what it would have cost you if you'd issued equity to get it, there's the terms of what it would have cost you to get debt to get it. And so broadly, on a company like ours, even if you're paying 6, 7, 8% for debt, typically a cost of capital can be 25% in terms of the true cost that you need to get a return greater than. So if you look at that and you say, people should, look at that in a different forum, and they'll understand what I'm talking about. So certainly we look very much at, okay, if you're doing pure greenfields exploration, then you're taking, you've got a 10% chance of, 5% chance of likelihood, but the chance of that money going from being worth $500,000 worth of drilling to $5 or $10 million worth of drilling, as many of the junior explorers you'd speak to are, is the chance is low, returns are outsized. When you're in operations, it is around every single extra ounce you can get out of your existing infrastructure, out of your existing mine, has an outsized return. Absolutely ticks that investment criteria. So what we're looking at internally, what I think about a lot internally, is what can I do to shift, take Costerfield, 49,000 ounces last year. How can I make that 55,000 ounces whilst maintaining the same cost base? Where should I be drilling that might move the ore feed by 2 grams per tonne? And then it's for free, even though I've mined a different part of the ore body. Did I Björkdal? So it certainly decouples the need to chase a debt repayment, to aggressively pursue reserve life only in one mine when it potentially more profitability for the money could be in another places. It certainly decouples that, and a fourth asset, growth, would assist that further. I'll probably leave it there because we're getting into sort of philosophical territory.
Yeah, no, but I don't mind this, because it's just coming at it from a different perspective. Because as companies get bigger, the returns are generated in different ways. So, for instance, something you mentioned earlier, attitudes to dividends and share buybacks, right? So dividends, if the company's offering a 1% dividend, to me as an investor, I kind of feel that's neither here nor there. It's not going to change my day. Share buybacks, if done in big enough quantities, people take a different view on that one. But again, this return on invested capital, how do you currently feel, having just completed a merger? You talked at the beginning of this conversation about potential acquisitions of a certain size. Do you feel as a board, have you got a leaning towards how you would prefer to allocate capital, or is it too early to be talking about dividends and share buybacks at the moment? So
it is too early, because we're stabilising as a company and understanding how we can maximise the underlying cash flow and value out of the business. So if we can move organically to 190, 200,000 ounces, massive difference in revenue and profitability for the business. So we want to pursue that pretty aggressively over the next 12 months. And what we don't want to do is restrict that capacity given the return that comes from that. So imagine we could do that by grade or mining substitution, moving from say 170 to 200,000. You're talking 150 million bucks, 30,000 ounces at 5,000 Australian an ounce. It's not going to cost you anywhere near that to get that extra production. So the leverage of that is remarkable. So what we don't want to do is in any way put ourselves in a capital stress situation so that we couldn't pursue that if we wanted. So that's why it is too early. But when you do get to that point and you're very convinced that you're steady state, then absolutely, dividends, buybacks, they show a degree of capital discipline. But like you talk about, they need to be substantial, they need to be meaningful, they need to get something. And it's very interesting, just looking at the peculiarities of the ASX as it stands, companies like Ramelius, Regis, who have been building cash balances very aggressively, are seeing outsized returns. So at the moment, it would appear that the share prices of companies are being rewarded for keeping that flexibility and more than otherwise. But that put your comments below. Matt will read them and get back to you. That's
thanks for the extra workload. The other thing is, with this kind of merger, you're just sticking with it, because I think that's obviously the story of the day, quite frankly, where you're going to have inputs from whichever consultants, whichever advisors on things like the FX risk, like the tax efficiencies to be had. Because, I remember when I first started off in this game, working with, I think it was Ford, but, we were looking at Porsche. They were making more money on their FX than they were selling cars. So, these things are important. So that's something, like the cash reserves aren't, huge at the moment, but they may be. So how do you look at stuff like that?
Well, we look at the management of those things for the purposes of running the business as distinct from financial speculation. So let's say we made $10 million on FX. That would be a happy coincidence of us seeking to protect the business at a certain point, right? So let's say we were, in our particular case, should the Aussie dollar rise against the US dollar, then our Aussie dollar returns will fall. So let's say we took out hedges to protect Aussie versus the US, and let's say we hedged 50% of our cash flow. I'm giving up examples. I'm not in any way saying this is our strategy. Then, of course, we would appear on paper to make money on those hedges. The reality, of course, is that we lose money on the other ones. So when you put some sort of financial instrument in place to protect the business, it is an insurance cost that you hope doesn't get triggered, right? We are absolutely not, I can reassure everybody, we're not in the business as a company of taking a hedge or instrument position on the hope of making money just by virtue of that as an additional income instrument. That's just not what we do. So in general, we will be moving stuff to Australian dollar because we continue to make sales in US dollars. There's a natural hedge that occurs from that as we convert back. There's a natural hedge. We may protect Aussie krona just so that we can show people how we, meet our guidance. But that will just be to do stability should we make some kind of investment. So our thing is, if we have a set of scenarios and we're happy with it and it makes sense and we're going to do profitability and there is a protection, puts, hedges, whatever it is, then we would execute that.
Okay.
Things to note. As a broad rule, and you would have seen this for so many of the people you've talked about, even though hedging is a very acceptable financial instrument to manage that risk, in general, investors have shifted for a while there's so much volatility in gold, to, if you're going to protect risk, preferring to see the purchase of puts as an insurance cost as distinct from anything that caps the upside. That's as a broad thematic, and that's a thematic that we pay close attention to.
So again, just trying to get the kind of the thinking of you and the new team there. We saw beginning of this year a lot of excitement around antimony, and companies swinging from whatever they're producing to now antimony. It seemed very knee-jerk to me. Obviously, you've got big company, big assets, gold, copper, antimony. Do you change your plans in reaction to macro scenarios in the marketplace?
Look, there's nothing in amongst the current strategic view of the board that sees us shifting to an antimony focus as a company. We very much see ourselves as a gold company in terms of the profit that comes from antimony, it'll be less than 10% of the company's profits. That said, Costerfield's a wonderful asset, very well run, and we'll make hay while the sun shines. And of course, if there is strategic advantage that can come from being the West's largest producer by far, then we'll seek to maximise that. But putting all that into perspective of the percentage of the company's revenue that it is. So you're right. It's volatile. It's strategic. We're an established player that's been running for nearly 20 years in the space of antimony customers all over the world. We'll just continue to do that and engage with parties that want to engage with us constructively. As you're aware, in this critical mineral space, there are some serious people that are talking, and then there's a lot of hot air.
There is, but it's kind of nice to see some of the, certainly the US Department of Defense seems to have changed the fortunes of many in the critical mineral space, not least rare earths at the moment. So it's nice to see governments moving that way. Look, I'm going to let you go because I know you guys just obviously you've announced the approval of the merger. It's Friday night in Australia. I think you should go and celebrate that, and we'll see you soon, sir.
Thanks very much. Hopefully we'll catch up in Beaver Creek Precious Metals Summit or Denver Gold. That'd be fantastic, mate. Look forward to seeing you then.